There's an account that lets you contribute money pre-tax, invest it so it grows tax-free, and then withdraw it tax-free for medical expenses. 3 separate tax advantages in one account. And the majority of Americans who are eligible for it either don't have one or don't know what it is. That's a health savings account. And if you're on a high deductible health plan right now, there's a real chance you're leaving money on the table by not using one. What's going on, everyone? My name's Eric Hunsker, and this is InsuranceWise. Let's go through exactly what an HSA is, how the triple tax advantage actually works, what you can spend it on, and why it becomes one of the best long-term financial tools you have if you use it right. The eligibility rule first. Before we get into why an HSA is useful, let's be clear about who can actually open one. To contribute to an HSA, you have to be enrolled with the IRS calls a high-deductible health plan, or HDHP. In 2026, that means a plan with a minimal deductible of at least $1,650 for individual coverage or $3,300 for family coverage. If you're on an employer-sponsored health plan or a marketplace plan that meets that threshold, you're eligible. One thing that changed for 2026, all bronze and catastrophic tier marketplace plans are now HSA eligible, even if they weren't specifically marketed as HDHPs. So if you're on a bronze plan this year, this may now apply to you. You also can't be enrolled in Medicare, be claimed as a dependent on someone else's taxes, or have secondary health coverage that disqualifies you. A common one that trips people up: if a spouse has a general purpose FSA that covers you, that may make you ineligible. So check with your plan administrator if you're not sure. The triple tax advantage. Here's why the HSA is in a different category from most other accounts. Most tax advantage accounts have one tax benefit. A traditional 401k lets you contribute pre-tax. A Roth IRA lets your money grow and come out tax-free. The HSA does 3 things at once. 1, contributions are pre-tax. If you contribute through payroll, the money comes out before income tax and before FICA taxes. If you contribute on your own, you deduct it from your taxable income when you file. Either way, you're contributing dollars that haven't been taxed. 2, the money grows tax-free. Once your balance hits a certain threshold, typically around $1,000 to $2,000, most HSAs let you invest your balance. The investment growth, dividends, capital gains, all of it is never taxed. 3, withdrawals from qualified medical expenses are tax-free. When you use HSA funds on eligible healthcare costs, you pay no tax on the withdrawal. Not income tax, not anything. That combination makes the HSA more tax efficient than any other account available to most people. A traditional 401k is pre-tax in and tax on the way out. A Roth IRA is taxed in and tax-free out. An HSA is pre-tax in, tax-free out, as long as you use it for medical expenses. There's no other account that works this way. The 2026 contribution limits. For 2026, the maximum annual contribution to an HSA is $4,400 for individual coverage and $8,750 for family coverage. If you're 55 or older, you can add an extra $1,000 as a catch-up contribution. The $4,400 individual limit is up from $4,150 in 2025. These limits adjust each year with inflation. You can contribute anytime during the year up to the limit, and contributions made before the tax filing deadline in April count for the prior tax year. That gives you a little flexibility if you want to top off your contribution after seeing how your year went. What you can spend it on. The list of qualified medical expenses is broader than most people realize. The obvious ones: deductibles, co-pays, co-insurance, and prescriptions. But the list also includes dental care, vision care, orthodontia, glasses and contacts, mental health therapy, chiropractic care, and over-the-counter medications, including things like allergy medicine, pain relievers, and antacids. Some that surprise people: acupuncture is covered. Hearing aids and their batteries are covered. Long-term care insurance premiums qualify up to certain age-based limits. Physical therapy qualifies, certain fertility treatments qualify, even menstrual care products are covered. What's not covered is health insurance premiums in most cases, cosmetic procedures with no medical necessity, and gym memberships unless specifically prescribed. Using HSA funds for non-qualified expenses before age 65 triggers a 20% penalty plus income tax. The IRS publishes a full list of Publication 502 if you want to check a specific expense. The biggest difference from an FSA. If you've used a flexible spending account or FSA in the past, then you're wondering how the HSA is different, here's the key thing. The HSA has no use it or lose it rule. An FSA generally requires you to spend the balance by the end of the plan year, or you forfeit the remaining funds. Some plans offer a short grace period or a small rollover, but the FSA is fundamentally a spend it this year account. That forces people into a mental calculation every November and December about how to burn through what's left. An HSA balance rolls over completely. Every dollar you don't spend stays in the account, continues to grow, and carries forward indefinitely. There's no deadline. There's no penalty for leaving money in there. The account is yours permanently. It travels with you when you change jobs or change health plans, and it just keeps building. This is the fundamental reason the HSA becomes a genuine long-term financial tool rather than just a way to pay for this year's copays. How to invest your HSA. Here's the part most people miss entirely. And it's where the real long-term value is. Leaving your HSA balance in the default cash account is like leaving your 401k in a money market fund. It's just not growing. Most HSA providers let you invest your balance once you clear a certain threshold, typically $1,000 to $2,000. Once you're past that floor, you can move excess funds into index funds. Fidelity's HSA has no account fees and includes broad index funds with expense ratios near zero. Lively is another popular option with no fees and solid fund access. If your employer's HSA has limited options or changes fees, you can transfer to a better provider without any tax consequences. Now stick with me here because the math on the next session is where this all adds up in a meaningful way. The Shoebox Strategy. This is one of the more powerful HSA strategies, and most people have never heard of it. Instead of using your HSA funds to pay for current medical expenses, you pay those out of pocket and save the receipts. The HSA sits untouched and keeps growing. Years later, even decades later, you can pull those old receipts out and reimburse yourself completely tax-free. The IRS does not set a time limit on when you can reimburse yourself for a qualified medical expense, as long as the expense happened after you opened the account. That $800 dental bill that you paid out of pocket in 2026 could become an $800 tax-free withdrawal in 2040 when you want extra cash, as long as you keep the receipt. Every receipt you save is essentially a future tax-free withdrawal voucher. The more you can pay current expenses out of pocket, the more the HSA grows and the more flexibility you have later. The retirement angle. Here's where the numbers get genuinely interesting. If you're 40 years old and you invest $4,000 per year in your HSA through age 65 at a 7% average annual return, you'd have approximately $270,000 in that account by retirement. All of that comes out completely tax-free for medical expenses. And healthcare costs in retirement are significant, often running $300,000 or more per person over the course of retirement. Once you turn 65, you can withdraw HSA funds for any reason, not just medical expenses. Non-medical withdrawals are taxed as ordinary income, exactly like a traditional IRA. Use it for healthcare and pay no tax. Use it for anything else after 65 and pay regular income tax with no penalty. How to actually open one. If you're on an eligible HDHP through your employer, check whether they contribute to an HSA on your behalf. Many do, and that's free money you should be taking. If you're on a qualifying marketplace plan, you can open an HSA at a bank, credit union, or brokerage. Fidelity charges no account fees and has strong investment options. Lively is also popular for its clean experience and no fees. The account is yours permanently, and it doesn't go away if you change jobs or plans. If you're shopping for health coverage and you want to factor in whether a plan qualifies for HSA, we'll put a link down in the description as a good place to compare options. The HSA is one of the most underused financial tools available to people on high-deductible health plans. Pre-tax contributions, tax-free growth, tax-free withdrawals for medical expenses, no use it or lose it rule, a shoebox reimbursement strategy that lets the account grow, and a retirement account backstop after 65. If you're eligible, the question isn't really whether you should have one. It's how much you should be contributing and whether you're investing the balance rather than leaving it in cash. Now, if you found this video helpful, make sure to subscribe if this kind of breakdown is useful. We cover insurance in plain terms so you can actually make good decisions with it. And if you want to go ahead and check out those options down in the description, we'll have links for it. Just know these are affiliate links, which means we do earn a small commission if you use them at no extra cost to you. But other than that, thank you so much for watching, and I'll see you here in the next video.